We looked at the format in the last little video, and then you might have to ask, why do we have to learn this? I already told you why they require the statement. But reason number one, there's a lot of estimates on financial statements. With depreciation, you're estimating the useful life, and so you're estimating the salvage value. With bad debt expense, you're estimating based on the percentage of sales or percentage of receivables. So there's plenty of room for what you'd call manipulation of earnings. It's called earnings management, and what it is management has a lot of incentives to hit certain income targets. So when you're looking at earnings per share, okay, and this is earnings per share, that's basically your net income divided by the number of shares outstanding, number of common shares, and all that good stuff. And so this is, analysts and everybody really focus on this. So if your earnings per share come out at $2.10, you can say, is that good? Is that bad? It depends on what you were aiming for. If you have a company that's going along like this, and your earnings per share were $1.96, and then you were aiming for $2.15 here, and you came in at $2.10, chances are you still went up in earnings per share, but you didn't hit the target. And what happens, a lot of times the market reacts and your stock price will go down simply because you didn't hit an earnings target, even though you were still going in the right direction. So for that and a variety of other reasons, management has a lot of incentives to hit those earnings targets. So say your operations don't come out quite where you want to be. Well, if you, if you say you've got $100,000 in revenue, and you usually take, depreciation expense of $1,000, if you extend the asset's useful lives, you're dividing by a bigger number, and so maybe you could get your depreciation down to $800 just by changing the estimates on your depreciation, or by changing the salvage value. Or maybe your bad debt expense, you decide, we need to get our income up a little bit. Instead of having a 4% allowance, we'll change it to 3%, and that would reduce your bad debt expense and increase your net income. And that's all from what you call accounting manipulation rather than from operations. And this is not a good thing to do, according to generally accepted accounting principles. So anyway, on the income statement and the balance sheet, there's really lots of room for manipulation. That's less so with the statement of cash flows, because you're dealing with cash, pure and simple. It is possible to manipulate it, and companies have, with very poor results, but it makes it a little bit more difficult. So reason number one, we have a cash flow statement. You can sort of get a little bit more solid idea of what the company's actually doing, because there's far less estimates that show up on this statement. Reason number two, the cash flow statement will tell you what a company is really doing. The company puts out all of these news releases, and in their financial statements, they'll say, oh yes, we like to do blah, blah, blah. But the cash flow statement tells you the real deal. Where's the company getting its cash? Are they getting their cash from sales? In other words, they're getting it from revenues and operations? Or are they getting all of their money from selling off equipment and plant assets to pay their bills? Or are they borrowing heavy and issuing lots of stock and raising money that way? So it tells you where a company's getting its cash. It also tells you how the company is using that cash. Are they just paying big dividends to their happy stockholders? Are they blowing it all on perks and management bonuses? Or are they reinvesting in the company? Are they really buying new plant and equipment? So you can see, you can get an idea of what the company's real values are by looking at the statement of cash flows, because it tells you what they're really doing with their money. The next part of the notes on this, I think we've talked about. We're going to use the direct method. I'm sorry, we're going to use the indirect method, because that's used by most of the firms that you'll run into. And we're going to use a two-step process. We will do the worksheet for the statement of cash flows and then prepare the actual statement. And I guess the next step that we need to do before we get into the preparation is to figure out what are investing, financing, operating, and non-cash activities. And that will be the next podcast.